Now is a very interesting time for the home buying market and the mortgages. Of course, mortgage rates have gone high, and the days of it seems that the days of those sub 3% mortgages are over for at least for a long time. And so it has become very tricky for people to consider buying a home. And especially in 2022, before the rates went high, there was a frenzy in the housing market of trying to lock into that 5%, 6% mortgage before it went up to 7, 8%, and maybe even higher right now in 2023 and 2024. So in this video, I'm going to talk about a concept about like adjustable rate mortgages, because a lot of lenders are now kind of offering these kind of adjustable rate mortgages, or what they call ARMs. And the concept of ARM is that you have a fixed lower rate for a certain period of time. Sometimes it's 5 years, 7 years, or even 10 years. And then the interest becomes floating, or it starts adjusting with the economy. So in today's video, I'm going to explain a situation that I myself faced when I first took my home loan in 2017. So 2017, I was buying my first home in the US. And at that time, the interest rates were about going for 3 to 4% then. And because I was a new immigrant to the US, I did not have any credit history or a credit score. So I did not get the best interest, but at that time I worked with a lender, with a credit union who was ready to give me a good amount, kind of a decent interest rate. And so when I looked at the options, I looked at that one, I think the 30-year fixed interest rate was about 4.2%, and the and a 7-1 arm, which means my interest rate would be fixed for 7 years, but after that it will adjust to the market. And so that 7-1 arm was substantially cheaper. It was, I think, about 3.7% or so, 3.7 or 3.8%. And so naturally, I took that 7-1 arm, and there were other kind of reasoning behind that. That typically a person sells off his home within 7 years, so they upgrade to the next home, and or they pay off the loan. If you are very aggressive in paying off your mortgage, 7 years is a good amount of time where you can throw in a lot of money and be able to done with that mortgage. This is what kind of, if you look at Dave Ramsey's baby steps, one of the baby steps is to pay off your home. And Dave himself says that on an average, his followers pay off their home in 7 to 10 years. So that way, the 7-1 arm looked very attractive at that time. But so I also got a lower payment because of the 3.8% mortgage compared to the 4.2%, which was a 30-year fixed. So I started with that. But after a few months, even when the interest rates were still fluctuating a lot, then I kind of got a bit uncomfortable that what happens after 7 years? What if the market is in a situation where I'm not able to sell the home, I'm not able to upgrade, and the mortgage rate starts going up? Now, remember, at that time in 2018, there was still euphoria in the markets. People were saying that interest rates will never go up in the US, or the US government will be able to keep the interest rates down. And because that is what they have done for a very long time after 2008. And so even with that euphoria, I was not getting very comfortable. So what I did instead was, after a few months, I again refinanced to that 30-year mortgage. Now you can say that this was kind of a bit of indecisiveness, but at least that finally that decision came at the right time, where I was able to move to a 30-year mortgage. And because I just wanted a kind of a sense of, first of all, if I have to stay in the home for 10 years or so, then I wanted that I should not get any surprise in my mortgage payment, because otherwise it will completely upset my budget, and I will not be able to plan for other financial goals that I have along the way. The second thing was also that if the inflation goes up, then having your payments being fixed and kind of transferring that risk to the lender is actually a very smart move. So even though my payments grew by a few, maybe tens of dollars, maybe $50 or $60 as my interest rates moved from 3.8 to 4.2%, but that payment then got fixed for a very, very long time, for almost the next 30 years. And today, if you look at the situation today, which is around about 6 to 7 years from them. I took that loan in December 2017. So in December 2024, it will be 7 years. So my ARM would have expired in December 2024. And with no sight of the interest rates coming down, maybe they will go higher, even if the US is not able to control the inflation. So what would have happened to that ARM? So today, when I think about it, my interest rate would start jumping almost 2% every year. That was the condition in that 7/1 ARM, and up to a limit of, I think it was about 8% or so. So you can imagine that in the next 2 to 3 years, that 3%, 3.8% interest rate on that mortgage would have become almost 8% in the next 2 to 3 years. And so my payments would have become almost double to triple of what I was paying. So this is the danger of kind of locking into, or kind of getting into that short-term benefit of an adjustable rate mortgage. So I'm not saying that in certain scenarios where maybe you are acquiring an investment property which you know that you are going to sell in 5 to 6 years, kind of you are going to improve that and flip it. There are so many different real estate strategies. In those strategies, it may help. But when it comes to your primary home, always remember that there are so many constraints that may come along the way where you may not be able to upgrade. And I actually did try to upgrade in 2022, but then what happened to the market? That time the housing market went completely in a frenzy of, let's say, it became a seller's market where buyers were falling over each other, paying much higher than the asking rate. And I kind of backed off from that market. I said, this is not the right time for me to buy a new home. And so the only option I had was just sticking to the same mortgage and stick to the same uh, the same home. Now, luckily, one other thing that kind of worked in my favor was when I refinanced it to 4.2%. After a couple of years, the interest rates came even further down. So finally, I was able to refinance at a very, very low rate, which is, I think, 2.875%. And that way, now I am locked into a very low rate. But imagine if that time I would have kept that 7/1 ARM, considering that this is what kind of, I'm going to sell off my home, so let me pick the smaller payment. Then I would have been looking at a much higher payment today, or at least starting next year onwards, that as that 7-year period expires, the interest rate would have started inching upwards. So always be careful, always kind of look at your own situation. Do not go by the internet wisdom, or do not listen to your lender completely. That what will, because they will obviously, they are into this business, they will obviously try to shift part of the risk to you. But it is your duty to look at your current situation, project yourself at least 7 to 10 years ahead, and then figuring out that what will be your situation, and always look at the worst cases, don't look at the best cases, because once you evaluate the risk correctly, you'll be able to take a much better decision. And maybe the interest rates would have stayed the same, let's say at 4%, I would have paid a little bit higher because of that, but at least I had taken that risk out of my financial system by giving up that 7/1 ARM and going for this 30-year fixed mortgage rate. So hope you like this video. Please click the like button below and subscribe to my channel. That way YouTube will be able to show you such videos, which I call the Pareto principle of personal finance, where you do the 20% right, and those 20% decisions are going to create 80% of the results in your life. Thank you again. Bye.